If we forget the performance of our investments for just one moment and instead, let's look at how safe your investments are should the investment platform or fund fail. The first question that we need to ask is, are our investments protected at all if the investment platform fails? There's no point making an absolute killing on your investment if you would lose a lot should the investment platform go bust.
Many of you watching either have already or will have in your lifetimes massive investment pots. If you're anything like us and hoping to achieve financial freedom, then you will be building up an enormous investment pot that will generate you an income while you enjoy life. The way life was meant to be. You'll never enjoy it fully if you're worried about losing it.
You might not have put much thought into how safe your investments are, because you may have assumed that the UK government wouldn't abandon you if the investment platform did go bust. Surely they wouldn't. Or perhaps you know that your investment pot is below the Financial Services Compensation Scheme limit and think you're safe, when it's not that simple.
We're not financial advisors, but we have carried out extensive work to corroborate all of the points in this video. It would be worthwhile doing your own due diligence before applying what we say to your own investment portfolios, but everything we do say is believed to be accurate at the time of filming.
So with that said, in this video we're going to detail all the protections that you get with your money, what you can do to further reduce risks, and what you need to look out for. Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Now let's get into the video. Financial Service Compensation Scheme, FSCS. The FSCS is the protection scheme that will likely save your bacon should your investment platform or fund go bust. It's essentially a completely free insurance policy as it's funded by the financial services industry. Actually, it's not really free because it's funded by levies on authorised firms, and they will of course pass those costs on to their customers, i.e. you, via their fees. So you indirectly do pay for this protection.
Taken straight from the FSCS website, the FSCS exists to protect customers of financial services firms that have failed. If the company you've been dealing with has failed and can't pay claims against it, they can step in to pay compensation. In 2008, they recovered £20 billion, so based on that history, we can consider it to be reliable protection.
The first thing you need to do, this is the most important thing we will say in this video. Before you make any investment, you first need to check that your investment provider or advisor is authorised by the Prudential Regulation Authority or the Financial Conduct Authority to carry out the type of regulated activity that FSCS can protect.
How do you check? If you're going with a well-known company like Interactive Investor, you can assume it is, but to check it's relatively straightforward and it is better to be safe than sorry. Every company that is regulated will say it somewhere on their site, but obviously don't trust that because any company that is hoping to defraud you would pretend to be. And here it is on Interactive Investor's homepage.
To check properly yourself, you need to find their FCA's reference number. If we use Interactive Investor as an example, they publish their FCA number on their disclosures page. A page that only people as sad as us would care to visit.
Take the number and bang it into the FCA site to check yourself, and boom, there you have it. This is a firm that has been given permission to provide regulated products and services.
Companies like Free Trade tend to be very transparent about their authorised status and protection. Free Trade have a dedicated page detailing this and even links straight to the FCA's page, and here we can see it.
How much is protected by the FSCS? Your investments are protected up to £85,000 per eligible person per firm. This seems like a paltry amount, but this protection works alongside other protections, so in practice the protection is much higher.
According to an article from Money Week magazine, their conclusion was that if your investment pot were worth twice the FSCS limit, losses would be very unlikely. And even if it was 10 times the limit, the risks are probably still low. Now let's look at why this is the case.
Client money and asset rules. Investment platforms are required to separate client money and assets from their own resources. This is a crucial piece of protection because they are not permitted to use client money and assets in operating their own business.
Your investments, including any uninvested cash, are ring-fenced in the event that the platform became insolvent. They would be unable to touch your investments or your money. However, if the platform did become insolvent, the appointed administrator is entitled to claim their costs for distributing client money and assets from the client money pool. We wouldn't worry about this kind of loss though, because anything that you do lose in this way is covered up to £85,000 per client by the FSCS Protection Fund.
From what we've seen from past broker failures, the FSCS protection on top of pooled client money has been adequate protection for almost all clients.
What about funds and ETFs? This subject has the potential to cause confusion, but we'll keep things simple. Most ETFs are not domiciled in the UK and will tend to be domiciled instead in Ireland for tax purposes, but this throws a spanner in the works. These ETFs will be authorised in Ireland, as can be seen here in the Vanguard FTSE 100 ETF Key Investor Information.
So what does that mean? Firstly, it means that your collective investments that are domiciled outside of the UK are not protected by the UK protection scheme. We did a lot of research here to try and determine whether the Irish equivalent protection scheme covered Irish domiciled ETFs, but couldn't find anything conclusive, with various sources contradicting each other.
From what we found, it looks like Irish ETFs are not covered by an Irish equivalent of the FSCS. The saving grace is the ring fencing rules, and if we quote some Vanguard documentation, in practice, for all UK and EU authorised funds, the underlying investment must be held separately from the fund manager by an independent trustee or depository. With both Ireland and UK authorised funds, in the event that a fund provider defaults, the underlying investments will remain intact.
In any case, the Irish protection scheme is pretty lacklustre anyway, with the maximum protection a dismal 90% of your loss up to a max of just €20,000 per investor.
How can you reduce risks? The larger the investment firm, the safer your money should be. The firms themselves are likely to be more profitable and therefore safer. For many of the big platforms, you will be able to check them yourselves, as they are publicly listed companies such as AJ Bell and Hargreaves Lansdown. You will want to check their accounts, history of its key people and news about past activities. These checks won't be as easy for private firms.
The bigger the platform, the more the FCA will monitor its activities and hopefully therefore reduce the chance of mismanagement. As your investment pot grows into the hundreds of thousands, you might want to start purposely splitting your money across multiple investment platforms for added peace of mind. This currently is a nuisance because in part you get reduced fees on larger investment pots. But we see a time in the not too distant future when platform fees are eliminated across the board.
Should you be worried if you have less than £85,000? The short answer is yes, you should be partially concerned. You won't lose any money as you would be compensated. But to reclaim the money from the FSCS could take many months. At time of filming, they are saying it will take 7 months to reimburse claims relating to investments.
There is an opportunity cost of having your money tied up for that amount of time. You may need the money to live. There might be a crash in the markets that you need to take advantage of, or you may miss out on a huge growth in the markets. At least you will be compensated for the amount you lose due to broker failure. Remember, this compensation scheme is not in place to protect you against poor investment performance. But on the whole, don't worry about too much. It's almost always better to hold investments than to not. And cash is riskier to hold in our opinion because you don't get the ring fencing protection that you do with investments. The protection is there should the worst happen, but until then, keep investing with confidence.
Question of the day: how do you reduce the risks related to broker failure? Let us know in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.